Welcome back to another episode of What's on Your Mind. I'm Chris Quill, and if you guys are new to the What's on Your Mind show, then basically what it's all about is giving you guys access to sort of professional level trading minds. And with that in mind, we've got Jason McDonald here and Ben Berggreen joining me on the show. These guys are ITPM senior trading mentors, and obviously very, very good at what they do. So, gents, welcome to the show once again. And Jason, I think we'll start with you this week. Why don't you let us know what you've been thinking about?
Yeah, thanks, Chris. Hey, Ben. Hey, everybody. So I've actually got two short ideas today. Just, I suppose, briefly on the market. Obviously, we've had the Fed meeting, and we've had some commentary out of that. It looks like at the moment the commentary has turned, I guess, more hawkish than people were expecting, especially with with the sort of the other geopolitical backdrop that's happening. But what's interesting is that we've obviously seen quite a kind of risk-on rally. I'm not really sure it is actually risk-on. I think it's more probably an indicator of how people have been hedging themselves, and those hedges have been getting unwound over the course of the last few days. So I think we're probably at a fairly interesting moment at this point in terms of the general market. That being said, as everyone knows, we are long short guys. So we're not out there making heroic direction views on the market. It's very much a case of building a long short portfolio. So without any kind of further ado, I'm going to go into my first short idea, which is a company that I'm sure everyone's familiar with. So the company ticker GE, it's General Electric. Market cap is $100 billion. Net debt just shy of $20 billion, which means it has an enterprise value of around $120 billion. Share price as of last night's close, $94.90. So probably going to whiz through what they do, because I'd imagine that most people do know what they do, but just in case. So, of course, they're involved in jet engines, airframes, energy production solutions, so things like offshore wind turbines, medical imaging technology, and as a lot of you will be aware, that there's also a leasing and financial services aspect to the business. They've got a few operating segments along which they have their reporting lines. So the most important one being the power segment, which is steam and gas turbines, power generation services, generators, gas power. Within that, they've got the power services and the gas power systems businesses. As a sub-segment of the power segment, they've also got something they call the power portfolio, which is stuff like the GE Hitachi nuclear business and the steam power systems business. So that's the power segment. They have an aviation segment, as everyone knows, where they produce commercial jet engines and components and provide services in the aftermarket for those. There's a healthcare segment. So that's the medical imaging and the patient monitoring technology. And they have a renewable energy segment, which is where the offshore wind turbines business and the blades for both onshore and offshore wind turbines is housed. So onto the quants, as we always do. So we have, now this is a bit of a rebound situation for General Electric this year. So they've got very strong EPS growth both this year and next year. So for 2022, we're looking at predicted EPS growth of just shy of 60%, so 56%. And earnings growth predicted by the analyst community for next year, 2023, of 60%. In terms of the P ratio, you're looking at 29 times P multiple for 2022 and a PE coming down to 18 times for 2023. Now, compared to the sector PE for this year is 19 times on average versus GE's 29 times. And then for next year, basically GE trades in line on a P basis. So the P for GE being 18 times and for the sector being 17.5 times. In terms of the earnings growth, as I said, GE is really on the rebound this year and next. So they have much higher growth than the sector for this year and next year. So the sector average growth is around 7% this year and just into double digits, 11% for next year. And lastly, just rounding off on the quant side, we've got a dividend yield for the company of 33 basis points. So in other words, not really anything. And the short interest foots to about 1% of the free float. So basically there's no shorts out in this. Now, what's behind the idea? So I'll go to the macro first. So if we look at the sort of the general global industrial production situation, I don't think it's any secret that, you know, that's been decelerating even before the recent kind of geopolitical developments. If we look at, just the US Purchasing Managers Index for manufacturing, that's been falling since last October. It's now around the mid-50s for the latest reading, and I wouldn't be surprised if that comes down lower. I think that that could continue at least into the summer, if not longer. And I don't think that is just restricted to the US. I think that's a general global situation. So even before, the recent situations that have developed, I think we already had a cyclical downturn beginning. Now, I just want to be very clear. I'm talking about a slowdown as opposed to a recession at this point. Although I do believe that the risks are, somewhat skewed to the downside in kind of Fed speak. And, also at the sort of macro level, referring to the Fed, I think we possibly could be on the verge of a policy mistake here in terms of what the Fed's going to do with interest rates. We have seen that historically recessions do tend to occur around the Fed making a policy error. And also coinciding with high oil prices. And as we know, all over the news, we've already got at least one of those things. As I say, I'm not looking for a recession at the moment, but certainly a cyclical downturn. So that's the kind of macro background here. On the company specific front, I'd like to start off with looking at their income statement. So in the Q4 report, the most recent report, on a GAAP basis, they lost $3.55. If we strip out the various extraordinary items and adjustments, which are many, that number goes from a loss of $3.55 to a profit of 82 cents. Now, to give you an idea of how complicated and should we say opaque their income statement is, the head of industrials at JP Morgan, when these results came out, a guy called Stephen Tusa, this was what he had to say about their results. This is the worst disclosure, the least transparent set of numbers we have ever seen in the 20 years following the industrials group. So I think fair to say there that, their income statement and their other financial statements are complex, shall we say. Now, if we want to make it really simple, what we can see is that for the whole of last year of 2021, they generated revenue of $74.2 billion, and they incurred costs of $78.8 billion. So that obviously implies an operating loss of $4.6 billion. And I think that's probably, what I would focus on here. So that's number one. Number two, this was initially greeted as a kind of a ball point. At the end of last year and back in November, they announced plans to split the business up by 2024 into three parts. So an aviation company, a healthcare company, and an energy company. So the energy company will actually be the largest part of that business. That would be 46% based on last year's revenues. And that is a combination of their renewable energy, power, and digital businesses. Then you've got the aviation business, which would be 30% of last year's revenues, and a healthcare company, which is about 25% of last year's revenues. Now, that sounds like, as I say, a possible ball point. However, the way they're going to go about this is that they are going to be building duplicate headquarters, management teams and systems and back offices for each new unit, whilst also unwinding the finance division, which people like Ben and I can remember all those years ago when this conglomerate was being put together. That's quite a complicated business in its own right, and I just think that the costs of this split are going to lead to more one-time hits to the income statement, and possible write-downs and stuff, which again, for me is another bear point. The company itself, they've already earlier this month been guiding expectations lower. They have been predicting just a couple of weeks ago that organic revenue in the non-financial related businesses for this year are going to be experiencing low single-digit organic revenue growth. So that's pretty anemic, and it's basically guiding expectations lower. And then lastly, there's something known as the rule of 2 times or 2x, which some people might be familiar with. And it really works like this. If you take an industrial company, now the key thing here being that industrial companies do have genuine costs of depreciation and interest and taxes. This company, pre-depreciation, interest charges and taxes, it looks like it's on 12.5 times EBITDA, which is hardly demanding. However, once you deduct depreciation, interest and taxes, you've got a company that's now on 25 times EBITDA. So that's 25 times earnings, which I believe are pre-downgrade. So that's the last thing. Now rarely does valuation in and of itself lead to the share price dropping. However, you might argue that in this kind of environment that we're now definitely more sensitive to valuations than we were, let's say 6-8 months ago. We're still looking for catalysts to drive the trade. So at the moment, we've got 24 analysts covering the company that make recommendations. 17 of those 24 still have it as a buy. There's not a single sell on the stock. So I think we've got room there once they start to disappoint as the year progresses for the reasons that I've outlined. I think we've got room there for recommendation downgrades. And I also think that, that's going to be on the basis of earnings and revenue downgrades, which is effectively what I'm looking for. They have their next earnings report. It's expected around April the 26th. It's not declared yet, so we're waiting for that date to be finalized, but it should be around the end of April. So what I've gone for in terms of my trade structure is I'm looking out at the June options, so the June 17th expiry, and I'm looking very simply at an 80-90 put spread. So in other words, going long the June $90 put and short the June $80 put. The stock's moving around a bit today. It's actually down a bit today, so that spread's a bit more expensive today. But you can get this on for around $2.50, which is going to give you your kind of 3-to-1 ratio, win-loss ratio that we're looking for when we stick an options trade on. So yeah, that's the GE idea.
Awesome. That sounds great. I mean, as you say, loads of space for that one to move and get derated with all those analysts having buy recommendations. Also low short interest, like you said, as well. So plenty of room.
Yeah, definitely more consensus short.
Yeah. Ben, let's go over to you then. What have you got for us?
Yeah, so first of all, I used to work for GE back in 2008. I was on their trading desk where we were managing like $200 billion worth of their pension funds. Now, the problem at GE, is as soon as things start going bad, that's the first to go is their asset management. Then they start outsourcing it. So they promptly shut it down like in 2009, the year after. Pretty frustrating. But, GE is definitely a company that has had a lot of problems and doesn't look like they're out of the woods anytime soon. So I like that one. Anyway, I have a little different angle today. Okay, I have a long and a short I want to discuss. But let's look at this long first. Okay, so I'm looking at Iridium Communication, ticker is IRDM. And they are a smallish, like $5.25 billion market cap company that focus on satellite communication. And it's really basically the go-to company for global sat phones anywhere across the world. And it's used by a lot of governments, military, emergency responders, and all that, which is clearly relevant now with the whole Ukraine situation. But not only that, is also used a lot for maritime aviation or anything that's kind of like functioning off the grid. And there's been a huge shift, especially after COVID, for that type of service or product where people want to be able to kind of function off the grid, and you have all those doomsday preppers and all these guys. So anyway, without going too much into that, I just want to talk a little bit about their satellites because it is pretty unique. So they have 75 next generation satellites in orbit. And what's different, I mean, there are competitors in this space, but what's a little different here is that most satellite networks use geostationary orbits that are about 35,000 kilometers from Earth. And the Iridium constellation are in low orbit, only 780 kilometers away. So what that does, long story short, it provides a much stronger and faster connection and makes the whole network more stable. And they don't require as massive like antennas and big power equipment and all that. And somehow they're able to set that up this way. And we can get into the nitty gritty of that, but we don't have time for that. So I'm going to power on. And another thing is in space, though, each of these satellites there's for each satellite, there's 4 others that's linked to each other. So it provides kind of cross coverage and redundancy, and pretty much always ensuring maximum coverage in anywhere you are in remote areas. So this idea, I came across this idea using the kind of the classic quantitative screening processes that we learn in the ITPM program. And in this case, I was looking for smaller stocks below 10 billion, specifically high P outliers with solid future earnings growth. And, we look into a lot of this stuff in the mentoring process also, but just to kind of give you the top of the iceberg, in this case, the EPS, it's been in the red, for the current fiscal year, but is forecast to turn positive next fiscal year and then beyond that. And it's, now it's negative 7 cents, and it's going to turn into positive 6 cents and then positive 28 cents. So these numbers are obviously minuscule, really. So even though the percentage gains is almost 200% earnings growth for the first fiscal year, and then 341% for the next one, you have to take it with a bit of a grain of salt because the numbers are so small. But nevertheless, is something to consider. So, and this puts the PEG, which is, we look at PEG as far as the PE over earnings growth for fiscal year 2 going to 0.41, which is quite low. And there's obviously a bunch of other factors to consider, okay? But I'm just touching on some of the basics. What I also like to do with all my trade ideas, I like to take a weekly longer-term chart, and then I'm a visual guy. I like to see things outlaid on the chart. When I was a kid, I used to like to read comic books for that reason. Anyway, and I always have the revenue and the earnings, trailing revenue and trailing earnings overlaid on the chart, which I have on this chart. And it, even though you're looking at trailing data, it definitely gives you an indication of how a company's fundamental has behaved in the past, which is clearly important. And it's nice to see it on the chart versus on a spreadsheet sometimes. But anyway, in this case, we're looking at the EPS on a trailing basis, which is this red line. And you can see that bottomed right around the COVID low. And then since COVID, kind of post-COVID, we had a massive positive shift in EPS growth. Even though EPS itself is still negative, it has shifted from getting closer and closer to neutral, and then, forecast to switch into positive territory next year. And then revenue has been, during this whole time, has been really stable, actually. And they made like $1,615 million in revenue for last year. And a lot of that was driven by the whole post-COVID era of, outdoorsy staying kind of off the grid type of idea. And also obviously now with the whole Ukraine thing going, it's just kind of emphasizing that whole idea. And I'm going to get back to that in a sec. But fundamentally, because of all this, okay, their operating income is up 475% since June of 2019, which is quite a big shift to the upside. And also, they have been buying back shares in the tune of $300 million worth last year. And they have an additional buyback program for another $300 million worth this year. And that is always a good thing. Now, the catalyst for this trade is, it's the whole kind of doomsday thing. But, more targeted, more specifically, a lot of this ties into the whole Ukraine invasion. And I have a lot of family in Europe. My wife has a lot of family in Europe. And people over there have been they've been going crazy buying iodine tablets, which are supposed to protect you from nuclear fallout. Does it work? Who knows? Okay. But the point is that they're buying this in droves, and these pills are not being sold for like 10 times the normal price. And this trend has also picked up steam in the US, where in Texas, this like doomsday bunker company reported 1,000% spike in sales just during this past month. And, all in all, buying sat phones kind of falls under that whole category, or kind of fear-driven Armageddon type of vibe. So I think we could see a solid boost in sales and earnings when earnings are released April 19th. Okay, and it's not the numbers, the improvement in the numbers is not totally dependent upon geopolitical landscape, as this company has been doing really well before, but it's just kind of the extra push for the next few months that is needed to make this trade work. Now, as far as the technicals, I do look at charts also. One of the guys who use charts quite a bit, not for idea generation purposes, but I like to look at them to come up with, to help them with the structuring of the options and also the timing of the trade. Okay, so I have two charts on there. I have a weekly chart, which I like to look at first to give me kind of the big picture scenario. And, the stock, when the stock hit this 32 level where it was at pre-COVID, there was very, very strong buying. Okay, so it confirms that the stock is still firmly in a longer term uptrend momentum where buyers step in at strong support levels. And then I look at the kind of the daily, zooming in on the daily over the past 6 months. And again, you can see the stock is, when I wrote this up a few days ago, stock was around 40, and it was pushing against this kind of 41 level. And then we're seeing some major overhead potential resistance at like 43 to 45, which I'll take into consideration when I structure this trade. And at the bottom of my daily chart, there's this kind of pink magenta line. That is the implied vol for all the options across all the chains. And I have that on there because it gives me an indication of how pricey the options are within the chain. So how much additional premium is applied to count in for that implied vol. So when there's in this case, there's been almost an implosion of implied vol that's been cut in half. That means that the options premium is going to be much lower price than what it was a month ago. And a lot of times that happens when a stock is rallying, as in this case. As far as the structure, it is a thin book here as far as the options go. So what I'm looking at is the April 40 strike as a long outright. And the reason why I'm looking at that is, first of all, we have earnings coming up. And when you look at the chain, this is really the only strike that has sufficient enough liquidity to put some size on. All right, so, and this will expire a few days before earnings, and we quite often see stocks getting juiced into an earnings release, and then the IV picks up, and you get a kind of solid spike in the premium. So that will kind of work out with the timing. So anyway, when I wrote this up, the 40 calls were at 180. So one contract would cost you $180 to put on. That's your max risk per contract. And let's presume the stock gets to 45 by the expiration in April. These options will then be worth $320, which is the $5 difference in the the last price versus the strike minus the 180 premium, $320, which is 180% return in 1 month. But we don't have a spread on here, so the sky is really the limit. If this stock gets to 50, let's say, it's over 800% return. So we most of the time, we'll structure these as spreads, all right? But in this case, since the options book is so thin, it just doesn't really work out. And so there's nothing wrong with just buying the outrights. And in this case, I think that could be the right call. So that's what I have on that one.
Cool. That was really interesting insight into kind of how you think about structuring using options in general. So yeah, thanks for that, Ben. Jason, then we'll go back to you. What have you got next? You said you had another short, I think.
Yeah, that's right. Yeah. So let's just get on to this. Okay. So the stock ticker is FAST. The company is called Fastenal. So you might even be able to guess from the name which business they're in. Market cap $33.3 billion. Share price closed last night at $57.75. So what do? No prizes for guessing. It's a US company whose main business is basically the wholesale distribution of industrial and construction supplies. As I say, mainly active in North America. They've got more than 3,200 company-owned stores. Pretty simple business to understand. They have two divisions. One is called the Fastener products line, and the other one is called, rather originally, the other product line. So what's in the Fastener product line? Well, two kinds of products, basically threaded fasteners and what they call miscellaneous industrial and construction supplies and hardware. So within threaded fasteners, you've got things like bolts, nuts, screws, studs, washers, etc. And in the miscellaneous part of that business, it's things like pins, machinery keys, concrete anchors, metal framing systems, wire ropes, struts, rivets, etc. And if we think about what are these things used for? Well, basically threaded fasteners are used in almost every manufactured product and building project, and also of course for maintaining and repairing machines. So the other product line is including tools, cutting tools, material handling, electrical safety, and welding supplies. So as we would probably surmise, their customers are basically in the manufacturing and non-residential construction markets business. In the manufacturing market, you're basically talking about customers who are the OEMs, original equipment manufacturers, and what's known as MROs, so maintenance and repair operations. And in the non-residential construction market, they're serving, sort of general electrical and plumbing contractors, road contractors, that type of thing. So pretty bog standard, easy business to understand. In terms of the quants, we're looking for the company at earnings growth this year of 12.5%, and next year of just short of 9%. That compares to the sector, which is growing quite a lot more strongly this year at 21.5%, and a similar kind of rate of growth for next year of around 9%. The P ratio for this company is 32 times this year's earnings, or this year's predicted earnings, and 30 times next year's earnings. Compared to the sector, there's basically three main players that are listed in this sector. The sector trades on 17.3 times for this year. That compares to 32 times for Fastenal. And the sector's trading on just short of 16 times next year's earnings, so 2023 earnings, compared to 30 times for the company. Dividend yield for these guys, a bit better than GE. It's at just over 2%, 2.15%. Again, pretty low short interest of 1.9% of the free float. So what's behind the idea? Well, it's there is a similarity here in terms of the top-down kind of macro view, which I'm going to come on to later on. So just to kind of give a little bit more of the background on this company, they've been around for a long time. They started to make acquisitions and kind of diversify a little bit away from fasteners back in 1993. But if we fast forward to last year, fasteners are now only a third of their total sales. So that's quite important with respect to one of the points that I'm going to make later on. I'm going to start with briefly presenting the bull case on the company, and then clearly, going to try and refute that because my idea is a short idea. So the bull case kind of relies on the fact that the company is very well run. The management are pretty shrewd. So they recognized very early in 2020 the opportunity that the pandemic provided. So they very quickly shifted part of their production into the manufacturing of masks, goggles, latex gloves, basically PPE and the like, which for that year gave them an increase in revenues of 5.9%. So hats off to them for 2020. That was that was smart and that was shrewd on their part. Also, these guys, they do benefit from inflation, and this is because their stores, which I mentioned earlier on, hold a lot more inventory than their competitors in the listed market, which is Grainger and a company called MSC Industrial, whose ticker is MSM. Now, this kind of benefits them in a couple of ways. So, first of all, because they've got this inventory that they built at lower cost because they manufactured these products some time ago, then obviously with higher prices today, that inventory is going to be selling at higher prices than when they produced the stuff. And number two, in terms of that inventory, it means that they're less susceptible than their rivals to supply chain disruptions, because obviously they've already got some inventory built up. And lastly, in terms of the bull points, the balance sheet is in great shape, quite frankly. The net debt at the end of last year was just shy of $154 million, which is less than 10% of the predicted EBITDA for this year. They're AA+ rated. Now, one thing I would point out here, whilst we're talking about the debt situation, obviously that feeds into the enterprise value. Now, the pre-pandemic kind of range for these guys in terms of their valuation was an EV to EBITDA ratio around 14.5 times. And that was the average across the 5 years leading up to the pandemic. Now, since then, and in fact now, the market has has kind of re-rated them, and they now trade on a greater than 20 times EV to EBITDA ratio. Now, I'd like you to kind of just keep that at the back of your mind as we go through the bear case for these guys. So, as with GE, I'm looking at the top-down picture in terms of an industrial slowdown. So I'm not going to repeat the figures for the US Purchasing Managers Index for manufacturing again. But needless to say, this is important for them because 69% of their sales are generated in the manufacturing sector. Okay, so that's quite important. Now, on the inventory point, this thing can work both ways for them. So I noticed some comments from a freight forwarding company called Flexport the other day. And these guys were saying that it now takes, on average, across their customer base, 115 days from when the factory says your goods are ready, come and pick them up. There's a kind of a lag of 115 days between that happening and when the products actually finally get delivered to the warehouse. Now, pre-pandemic, that was 50 days. So in other words, it's more than doubled. Now, what that means is that companies they're much less agile, and they've got a harder job in terms of they need to forecast what the demand is going to be for their products and place their orders accordingly for a time period that is more than double what they used to have to try to predict. Now that, I'm saying, is going to potentially lead to a change in behavior, because you don't really want to end up landed with a load of stuff that you've ordered on the basis of, what you were seeing in demand 115 days ago, which is obviously almost 4 months ago. So the other thing that I point out here in terms of kind of pre-pandemic, post-pandemic behavior is that in the Q4s between 2021 and 2019, so in other words, the Q4 immediately predating the pandemic and the end of last year, there was a massive shift in terms of consumer behavior, in that sales of consumer goods over that time period of the pandemic rose by 24.5%, while services only gained just shy of 6%. So it's not inconceivable that that behavior could be reversed, and that if that is reversed, you are going to generate, hence, therefore, a load of unwanted inventory. And as these guys hold more inventory than their competitors anyway, that would be a problem for these guys and could give them a different kind of supply chain issue. My next point is regarding competition. So as I mentioned, there are three main listed competitors here. So Fast, GWW, which is Grainger, and MSM. Now, it's quite a fragmented business, but in the last couple of years, a non-listed competitor has kind of appeared on the scene, called Affiliated Distributors. And these guys are essentially a cooperative consisting of more than 800 independent suppliers of manufacturing, construction, and industrial goods. And these guys basically, as you would expect from a cooperative, they pool their resources and they pool their buying power. And they have started to make considerable inroads into the markets of the big three. So to give you an idea of how they're performing, Affiliated Distributors last year generated sales of $59 billion, which is more than 2.5 times the combined sales of those three listed guys. They generated also, this is Affiliated Distributors, growth of more than 30%, which is 5 times the growth that Fastenal itself generated last year. So there is competition here. I talked about these guys starting their diversification and acquisition process a long time ago. The issue with this is that almost all of their growth into new products is margin dilutive, because fasteners is an unusually profitable business. Therefore, the other areas where they expand into are much less profitable. So for over the last decade, the proportion of sales from fasteners has gone from almost 50% down to 33% in terms of the overall sales number. And what that has led to is gross margins falling over the last few years from low 50% to now mid 40%. And in fact, management, again, back in January, have already started to guide down for a contraction in gross margins for 2022. And that was back in January. So that is before, again, we were starting to see all the sort of economic activity or lack of activity that we've been seeing over the last couple of months. So, they've got lower margin businesses that they've added, which are contributing to overall declining margins at the corporate level, plus that backdrop that I've been talking about. And then the next point that I've got really is their online growth strategy, which they have been kind of trumpeting as one of their strengths. When you look into it, it's actually not really anywhere near as impressive as they say. So they are really lagging behind the peer group, and they've only got 15% of their sales are online. To give you an idea of context, the competition out there, people like Grainger, they've got much greater online sales as a percentage. which of course is much less capital intensive. And that is, some of them are with online sales sort of greater than 50%. And that might explain, why we see certainly in Q4, Grainger reporting much stronger growth on a year-on-year basis than Fastenal. So, I think it's a well-known fact that distribution market is transitioning more towards e-commerce, but the true e-commerce exposure of Fastenal is actually pretty low compared with the competition. And so I think that, that's going to potentially hit their growth figures as well. So in terms of the catalysts, we've got next earnings are due before the market opens on April the 13th. The company, I would argue, it's trading at the premium that it's trading at on the basis of how it performed during the pandemic. And as we know, that's fast moving into the kind of rearview mirror here. So I think we're going to see a continuation of operating margin erosion. I think that we're very likely to see, not just because of the micro reasons, but also because of the top-down environment, disappointing sales and earnings numbers over the next couple of quarters against a kind of a difficult cyclical backdrop with a potential inventory build for them as well. Now, I'm looking at a slightly longer dated structure with these guys, which should take in 2 earnings reports. So giving us a longer time horizon for the trade to work. My target for the stock is $50 or lower. You can get the August 19th 47.5 put spread on for around $1.80 earlier on today, this morning. So if you can get that on for around $1.80, where you're buying the 55 strike, selling the 47.50 strike, if it gets down below 50, down to that kind of level, then you're going to be making just over a 3-to-1 risk reward on that. So that's how I structured it.
Cool, good stuff. Very thorough analysis, Jason. Thanks for that. Let's go to you once again, Ben, with your second idea.
Yeah. So, Jason, you make me look bad because that was very, very in depth. So I'm gonna do a completely opposite. Do something super simple and quite fast. Okay.
Apologies, Ben.
So anyway, going with this kind of I guess semi-bearish view on a lot of the cyclical kind of industrial space, I'm looking at a short play in Pool. So ticker is POL, Pool Corp. It's a pretty simple business. Okay, they build swimming pools, and they also do some other. Provide some equipment and parts, but in the majority of their sales is just from building swimming pools. So it's a pretty simple business. It's a $19 billion market cap company, and the stock did do really well through the post-COVID kind of buying frenzy. Everybody was nuts buying family homes and moving out to the suburbs and putting in pools and all this. Right, so the stock did really well. I would argue that this party is over and the stock has topped along with a lot of the home builders. Okay, so this stock is, even though they build pools, it's really a housing market type company. Right, so it's very, very closely tied to the housing market and builders in general. And I have again, I have a chart here. I just want to show the correlation, okay, between Pool and some of the biggest home builders in the U.S., Lennar Corp and D.R. Horton. So on this chart, the daily chart going back about a year, you'll see a white graph that's Pool. The orange is Lennar, ticker is LEN, and then the kind of blue kind color is DHR or D.R. Horton. Okay, and you can see they're highly correlated. Now, that's not a big shock, but this kind of visual presentation kind of emphasizes that point. So this is really a story then of a topping housing market. And from the quant perspective, we are seeing decelerating growth across the board for this stock and also for the home builders, where in like for Pool, for example, in in this fiscal year, they had they're reporting it, or they're forecasting a 10% or 10 and like it's a 10.5% earnings growth for fiscal year 2 is down to 7. Okay, and then DHI and LEN, same thing, more pretty drastic downward revisions for next year. And this also puts an upward spike in the peg. So valuations are basically getting cranked up, even though the stock prices are just hovering, right? So, and the thing is though, like buying a house, even though you're paying more money for the house than you can probably afford, that's one thing. But adding a pool to that house is an entirely different beast, and that's kind of, a lot of people just don't have the money to do that anymore. All right. Plus, that pool is coming down from much higher multiples, so they could experience a sharper decline. Now, if you look at this type of weekly chart that I have on with the trailing fundamentals as far as revenue and earnings again, the bottom 2 lines here showing the momentum of trailing earnings per share and trailing revenue. And the past 2 quarters, the momentum has been falling. So even though earnings and revenue has been climbing, okay, it's been climbing less and less. So that's one thing. And another thing is the inventories doubled. So they just went kind of all out, doubling the inventory through last year, increasing it to $1.3 billion worth of inventory by the end of 2021. And in addition to this, to pay for all this, they have tripled their long-term debt just last year to over $1 billion. And we now have, increasing rate environments. They're now talking about raising rates more than they were saying before, potentially getting close to 2% in Fed funds by year end. It's going to be pretty hard to carry a higher debt load especially if you have a reduced demand in that type of environment, right? So another thing is, if you look at a lot of the stats here in the US for home builders, it's definitely showing the market as cooling off, okay, where the building permits topped a few months ago and is now starting to decline. Other data showing the same thing. We also have inflation stuck at a 4-year high, and that's impacting materials in a big way that is needed to build not only homes, but obviously pools, etc. And I just don't think a lot of people that might squeeze out enough money to buy an overpriced house are also going to be able to buy a pool, put that in. We're getting to a point where fewer and fewer people can fit into that category. So you have supply chain issues, higher cost of materials, slowing demand, higher interest rates. Like, it's kind of a perfect storm for this company, I think. Now, for the technical oriented people out there, if you look at a longer term kind of weekly chart going back 5 to 10 years, this is really starting to look like a classic, like head and shoulder with a neckline at 435. When I wrote this up, the stock was at 476 and change. Pulled back a bit today. I think it's like at around 460 now. But and if the stock gives back most of last year's gains, which I think it will, it could easily get to 330 within the next 6 months. And even if it does that, it'll still be 100 points above the pre-COVID levels. Okay, so there's a lot of downside, room for downside in this trade. Now, the options book here is just really thin, right? It's just not a trade where you can really structure a good options trade on. So I'm looking at this as an outright short, where I would control risk by using a stop at 500. Now, if you have an outright short and using a stop, clearly you are, you're still at risk for massive gap up. So you have gap risk in case there's like M&A activity or something that could move the stock dramatically overnight. But that said, if this stock gets to 330, which is kind of my short-term price target, that's a 147-point gain from where it was when I wrote this up. And if the stock gets stopped out at 500, it's a 23-point loss. So that's a 6-to-1 reward risk. and this stock could very easily go to 300 or below also. Okay, so that's really all I have on this. So it's definitely not as elaborate as Jason's, but you don't have to be in this company because it is a pretty simple business, honestly, driven by pretty simple catalyst. So there you go.
Awesome. All right, gents. Well, we'll finish up there. Thanks to both of you for coming on the show once again and providing your sort of professional insight into what's going on in markets and also in your own portfolios. Look forward to catching up with you guys again on another What's on Your Mind episode in the months to come as well. So for all of you watching, I'm going to say this once again, as I've said in previous What's on Your Mind episodes, but this is basically your last chance now to kind of sign up for our WOYM events, which is coming up starting towards the end of the month, running for 10 trading days. And basically, that event is going to provide a huge amount of valuable content for you guys to learn from. So we're going to cover things like idea generation, risk management, portfolio management, trade structuring, basically all the things that the guys talk about on these What's on Your Mind episodes. And not only that, you're actually going to have sort of access to all of these guys, the ITPM senior trading mentors, over those 10 trading days as well. They're going to be talking about various trading topics each day, so in a webinar format before the US market open. And that's the other good thing about this event actually as well, is that it's all really relevant to the current market environment. So there's really nothing else like it that we do in terms of content and events. So if you are interested, then I do recommend you sign up for that. You can sign up for it by going onto our website, itpm.com. Again, up there, we've got all of our courses, mentoring programs, and other events as well. So I'll kind of leave the rest to you guys, make your own decision about that. But like I say, really valuable, and I do recommend it. Now, that brings me to the end of this episode. I hope you guys enjoyed this one. Bit of a long one, but I hope you guys got a whole lot of sort of information from that. And make sure you join us next time for another episode of What's on Your Mind.